everyone. Thanks for joining us today. I'm a little bit nervous about this presentation, more on the IT side than the content. I'm a little bit of a dinosaur when it comes to that, so just bear with me if there's any problems. Rhonda will step in and keep things smooth, I'm sure. I've been working at CSI since 2017, teaching in impact investment and also specializing in authentic assessments. And what that means is when students do actual, where they do assessments based on an actual recipient or audience who is going to really use the work. And it's all about enhancing the skills that they've already learned, the technical knowledge, into a real life context, what we call deliberately messy. I'm also a practitioner in the field of impact investment and really excited about what this sector can mean for society, more so than ever right now, and really excited about the work that CSI is doing in the sector from an education point of view, research, and catalyzing change itself. We're doing some exciting things right now at CSI in impact investment, so more than happy to hear from anyone watching today who'd like to get in touch separately, even if not based on specifically what we talk about today. More than happy to get in touch and talk about how we can work together, collaborate, or just share ideas. Also joining me today is Adam McCurdie, who is an old friend of mine, a friend of many years, he's not old, who is a very well-known practitioner in the field of philanthropy and impact investment. He is a co-founder and director of Humanitix, and I'll be providing largely theoretical context, and then he'll discuss that context when I finish. He'll discuss that context, how it relates to Humanitix, and finishing up with some Q&A where you can address your questions to either of us. I guess the first thing I want to do is really just define social impact investment and where it came from, what the drivers of it were, how we actually define it conceptually, and then we start to think about some of the business strategies that are required to actually make it happen. And I guess the first thing is social impact investment or impact investment is a business or an investment strategy which targets a combination of social and or environmental impact along with a commercially competitive return, financial return. And I guess for me, when I hear that, and whenever I speak about this to anyone, the first thing that really comes up is, why isn't that the only thing happening? Why is anyone investing in anything else? If you can actually create social impact and you can create financial returns in equal measure, why wouldn't everyone be doing this? And hopefully we can answer those questions a little bit today, so why it isn't all pervasive, whilst at the same time showing how it could become a little bit more pervasive. This is a quote which I think provides a pretty important context to the whole sector. So I'm sure a lot of you have heard of Larry Fink, or if you haven't heard of Larry Fink, you've heard of BlackRock. BlackRock's one of the most successful, most profitable investment houses globally. And Larry Fink is nothing short of a ruthless, successful, profit maximizing CEO. So for him, a couple of years ago to say this, and his actions subsequently have backed it up, for him to identify that a company needs to have a focus on both social and financial outcomes in order to prosper over time, for him to identify that as a necessity to operating is a pretty meaningful thing. This is not coming from someone who's outside the box or someone who is laissez-faire about profit. This is coming from someone who has made a career of maximizing profit. So what this tells me is that impact investment is moving from the peripheral of the financial market sector spectrum into the center. And over time, it would be my expectation that impact investment becomes potentially just investment. But for now, it's still a specialized subsector, but increasingly relevant to a broader spectrum of society and investment. So, as I said, just want to have a think about how impact investment has evolved over time. So it's really about thinking about the role of business in society, which is a pretty big question, especially now in 2020, I think more than ever. The GFC certainly raised it to a large extent, but even more so now, we're seeing how COVID-19's impacted the market and seeing how the bushfires impacted Australia, for example, global warming, how that's impacting society and will continue to impact society, and really thinking about what is the role of business. And in the 70s, for you economists out there, you'll remember the name Milton Friedman, and his view was that a corporation's single legal purpose in the world is to maximize profit, pay a fair share of taxes, and the government should use those taxes to cross-subsidize social factors and considerations. His view was not only were you out of your legal realm, where you weren't meeting your fiduciary duties if you were doing that, but in fact, I just saw a message saying that turn up my mic. Unfortunately, it's not the Mac, so I'll try and speak up a little louder. So he was saying not only is it your legal responsibility to maximize profit, but in fact, he was saying there are negative synergies in trying to focus on more than one thing. In other words, if you try to focus on social and financial, you'll let one or the other drop and the overall pie will decrease. In the 80s and the 90s, we saw the emergence of corporate social responsibility, or CSR, as it's written here, and more recently, sustainability. But that was largely reactionary to problems. So a big oil company has an oil spill in the Gulf of Mexico, and they put some money towards cleaning it up. Or a company starts sponsoring a football team. Things that were largely outside of the business model, so that it wasn't looking at saying, we make money through this function and we'll create social impact through the same function. It was saying, we make money through this function or set of activities, and then separately, we donate money or we contribute money to a separate cause considering our social impact. So the really important consideration there is that the initial movement to considering social impact through business was through a peripheral, often completely unrelated function. The GFC, the global financial crisis in 2007 to say 9 or 10, that changed things much more substantively. So that actually saw a rethink or reinvention of capitalism to some extent. And there's really three drivers of this. One is of any business, there are three drivers. You have investors, consumers, and employees, and the decisions that they make will drive the decisions of businesses. And I think, and my research and my personal experience tells me that actually the biggest driver of this change was employees. It wasn't consumers. I think largely consumers have still not really changed their behavior, not yet anyway. I think it's emerging. If a cup of coffee tastes good and it's well priced, most of us just buy it without really thinking about about the supply chain, for example. Certainly for bigger picture purchases, that really is the case. Investors, that's what we're talking about today, and that's changing now. But you still see a lot of investors, particularly large investment companies, that are still driven by a mandate that's outdated, and where they are still considering largely only financial considerations. But employees, a lot of employees lost their jobs or saw their career path change materially after the GFC, or they actually just realized, I don't want to spend my life contributing, even if I do get well compensated. I don't want to spend my life just contributing to something which actually erodes social impact, much less creates positive social impact. So you had a huge group of people who suddenly wanted to have a career that had a positive impact, but where they still didn't want to say, well, I've done an MBA at Harvard, or I've done the AGSM at UNSW, and I'm now going to accept a huge cut in my pay. Well, actually what people wanted was an ability to still pursue genuinely competitive salary packages or businesses if they own them, whilst having a positive impact on the world. And so I think that was really a big driver of this change. And theoretically and academically, that change really started to come through from Michael Porter when he developed shared value in 2011 and published that. And that became then an actual business strategy to actually incorporate social and or financial considerations, social and or environmental considerations, along with genuine financial strategies. And all of these things together can really be described as the intention to generate social and or environmental impact alongside competitive financial returns. There's a couple of key words there in terms of the definition of impact investment. The word intention is critical. So a lot of people say to me, hey, I work for a company that develops medicine. Does that make me an impact business? The answer is not necessarily. And the reason is that if you don't have an intentional impact strategy, then you might be focusing on what's profitable rather than what's needed for medically, or you might be developing it and not caring about whether it's actually accessible to broad masses of people. Whereas if you intentionally want to get it out there, then of course you'll be thinking about how to decrease the marginal cost and get it so that more people can afford it while still creating commercial returns. So intentionality is really important. And it's really important to also note that we need to create competitive financial returns. A lot of people say, hey, if I make any revenue at all, does that make me an impact investment? The answer is no. That may make you a social enterprise, but not necessarily an impact investment. We'll build that up a little bit now. But first, I want to hear a little bit about you. So we've got about 100 people logged on, and I'm very curious as to whether you're here for as an investor, as an investee, just in general interest, and this Menti poll is going to try to capture that. bear with me while I jump to the other screen in Menti, and you can actually dial in. Rhonda, you might just quickly describe how they can actually engage with this poll.
Sure thing. Hi, everyone. I've just put it in the chat screen as well. So if you go to this URL at Menti, the unique URL that's been provided on the screen right now or in the chat box, and then the code is there too, and it's 483423. Great. Some people have already entered it. Thank you, everyone. So once you do that, the live results will come through and Michael will talk to them.
So very interesting to see where this is showing initially. And the reason I say it's interesting is I started off by saying this is such a seductive concept. If we can create financial returns, competitive returns, and change the world for the better in the meantime, why isn't everyone doing it? And we'll go through that in a bit more detail, but the reason is it's quite hard. So you'll see here that a lot of people are of general interest. A lot of people, but in terms of being an impact business or an impact investor, there are more people interested in it than actually doing it. And the reason is, one of the main reasons is, one of the main hurdles is a lack of investable businesses. So there's a lot more capital that's interested in coming in than there are investable businesses. So those of you filling out that yellow column, interested in becoming an impact business, big opportunity for you guys. For those of you of general interest, you're the ones who are actually going to really make the big difference. It's always going to be early adopters and leaders in the sector, but the people who actually are not necessarily driven to do it, but just see it as something worth considering and learning about, and eventually start bringing in that line of thinking into their organizations, their banks that they work for, the charities they work for. That's where real systemic change will come from. So I think we get a pretty good feel for that. Rhonda, is this captured, this data?
Yeah, it is captured within Menti.
Right,
Yep, so you'll have it.
Think about that later.
Yep. So
okay,
if everyone, oh, sorry, I was just going to say we are doing 2 other polls later, so just keep your Menti up and we'll get to those polls soon.
Thank you, Rhonda. So jumping forward into some economic graphs. Now, I actually did a consultancy a number of years ago, very early stage for impact investing, to a sovereign wealth fund where we developed what we called a dual mandate strategy. And essentially it looked a lot like this graph. And on the back of that, I became very excited, and I thought I'd developed a tool or a framework that could be published, and I was going to do my PhD on it. And I enrolled my PhD, and in my first lit review, I found that Freyrick in 2009 had developed this. So it was very disappointing to realize that I hadn't discovered it, but nonetheless, it suggests to me that I was on the right path, given that it had been published. And I think it's a really great way of visualizing and understanding what it is that we're actually talking about. So moving away from words and into graphs. So we call this a capital market spectrum, and there are two axes. One is on the x-axis, which is the horizontal, which is social or environmental impact. So the further we go out to the right, looking at the screen, the bigger our social or environmental impact is, or at least our intended, are focused on impact. You can't always guarantee what you will achieve, but certainly our expected impact. The y-axis, or the vertical axis, is a financial return. Now there are two floors: a financial floor and an impact floor. The financial floor is pretty easy to conceptually understand. There are decades and decades of historical data that tells us what type of return that we need to create in order to attract investors. And it's not just a single number. It depends on the stage of the business, the sector. So you might be able to, a bank, for example, might raise capital at 4% because they're much lower risk. Government might raise capital at 2%. An early stage business might need to promise returns of 50% or 60% in order to attract investment at that level of risk. So the important thing here is not that that's a number, but that for every investment, there is a financial floor that you would need to be able to at least aim to deliver in order to attract commercial investors. The impact floor is a little bit more difficult to conceptualize. CSI has a lot of experts working in this field. I'm not one of them, so I'm not going to go into it in too much detail. Rhonda, you may be able to talk at the end of this, whether there's another presentation coming up that will talk to the impact measurement in more detail, or if it has been done. But the impact floor, essentially, we can think of it in the same way. Are you creating enough impact that you would attract government funding or philanthropic funding on a competitive basis without any consideration of the financial impact of financial flow. Now I want to add this line in. Now this is where I start to overlay my own theory on top of that Freirich map. And this line is what I call the Milton Friedman line. And essentially what that indicates is that there is a direct trade-off as you move from one to the other. So if you're operating in the top left-hand corner under profit maximizing, according to Milton Friedman, as you shift your focus from financial to social impact, it's a one-for-one trade-off. So you can choose, I want to do 80-20, 50-50, or 20-80, or 100-0, or 0-100. But he would argue there are no synergies by targeting both. And if you look at that there, if you think of this as a production frontier, if that is in fact the frontier, then impact investing doesn't exist. You actually are unable to create a material above the impact floor of both. Oops, how do I go back? That's all right, I'll leave it there. This next line, this green line that I've put in, which again, back to my technical skills, took me about an hour to draw that line. So apologies if it's not particularly well drawn. But what that reflects is what I would call the shared value line. I actually do want to go back if I can. Yeah, the shared value line. Now, what does that reflect? It reflects that essentially we would believe under this line that the potential frontier of what we can create increases as we actually focus on both, as we actually adopt a secondary mandate. So as an NGO adopts a financial mandate, or as a profit maximizing company adopts a social mandate, we can increase the total pie that we create. There are synergies between the two. Now, it's critically important to understand that this is not the case for every single business. This requires a really important characteristic of shared value, and that is that you create the social and financial outcome by the same business process. So you're not creating social impact on one hand and financial impact on the other. The whole concept of this synergy comes from the idea that you create both through both. So a good example of that, a few examples of that would be renewable energy, where there's an absolute correlation between creating more revenue and creating more impact by offsetting carbon emissions. Or for example, bottom of the pyramid economics, if you can create something that allows you to, yes, exactly, Kieran. So you incorporate impact into your core business strategy, or incorporate financial outcome into your core NGO strategy. We're going to differentiate a little bit further shortly between different types of businesses that incorporated in there. So the important thing there is you have to believe in the shared value concept in order to believe in impact investing. I always tell my students or investors or whoever I'm engaging with, you may not believe that, and the jury could be argued to still be out as to whether this exists. And this is something that you need to investigate yourself, and you need to investigate this for each business as well, that you may consider this should become an impact investment, or I would make an impact investment into that organization. Do they have a shared value line they can operate on, or are they operating on more of the Milton Friedman line? If you believe it's a Milton Friedman line, there is no reason to pursue impact investment. You may as well operate at one end or the other. So what this really does, it divides the spectrum into three segments. The first segment we're looking at, so basically anything below the Milton Friedman line, you could probably argue is not going to be sustainable. Eventually, it will be, it'll either, even if it's focused on one or the other or both, over time, more profitable or more impactful businesses will emerge, and they will eventually become obsolete. So basically, it's got to be above the blue Milton Friedman line. We'd love to operate way beyond the green line, but at some point there are trade-offs, and we'll talk about that shortly. It's impossible to keep going out and out forever. So essentially, it gives us three segments in between the blue and the green curves. The first one, you can see NFP written there, is the not-for-profit or the NGO, which also now is expanding into social enterprise. A great example of an organization that used to be initially would have been philanthropy, moved into social enterprise, and tried to move into impact investment is Street. So Street is a Melbourne-based cafe that employs at-risk or youths who are otherwise likely to be unemployable. The idea is they get a job at one of their cafes. From that, they skill up, and from there, they're able to go get jobs in other sectors. And they're a very successful social enterprise. So they're not operating down the very bottom at philanthropy. They have moved up towards the financial floor, but they actually sit under that financial floor. They're a very successful social enterprise in that they offset their funding needs but are they able to deliver a financial return? Well, they tried to. They actually raised impact capital, and unfortunately it didn't work out. They've gone back to being a very successful social enterprise. Now, why is that? Because they've been incredibly successful at having a share, at creating shared value. The way they create revenue is by the very way they create impact, by running their cafes. So why is it that they can't actually compete financially, despite having aligned social and financial aspects? They haven't actually created a business advantage through addressing the social problem. If I'm running a cafe next door, I can hire someone, a trained barista with essentially zero training costs, whereas they have $10,000 to $30,000 of cost in training up any person who works for them. So clearly, what they've done is they've identified a business mechanism to deliver their social impact, but they haven't identified a business opportunity which is arising from the social problem. A good example of something that has that is able to do that, I go back to the bottom of pyramid economics, where you could say, we know that in certain areas in Australia, for example, there's huge amounts of financial exclusion, and if we can come up with a way of actually bringing financial products to them in a way that they can afford to pay that's above the marginal cost, and no one else is targeting that market because they haven't developed the same product, that's an actual business opportunity through addressing a social problem. So there's a really important difference to identify there. It's really important there to remember, if you're in the field of investing, or if you're working for an NGO, if you're a consultant, to be able to differentiate between the opportunities that sit with any business. So if any of you are ever consulting, or if any of you are ever looking at raising capital, think about a couple of things. Think about where you sit on the spectrum. Think about where you could sit on the spectrum. And then the third thing is to think about how you get from A to B. But you must be honest and truthful about where you do sit. If you think you actually sit in that lower segment and you want to sit in impact investing, it won't work out. Be truthful and be strategic about where you do and where you could sit, and strategize accordingly. So then the next segment is the top left, and that is the for-profit. Now, again, there are a lot of for-profit organizations that have started to shift towards a bigger impact without necessarily going over the impact floor. There's a lot of examples of larger companies, mining companies, beverage companies, who have identified that they have to at least consider how to reduce the negative impact, if not create positive, without necessarily adopting the strategies required to go over that impact floor. And there could be two reasons for that. One is they may be creating social impact, but not a material amount of social impact. And the other is, even if they're creating a lot of impact, they may not be as intentional about it as they need to be considered an impact investment. In other words, they may not have put it into the governing documents of their business. They may not have it throughout the employment contracts of their business, and they may not have it in there as a genuine, ongoing, sustainable strategy. When push comes to shove, a lot of them will go back towards focusing on the financial product. That's not to say that's not a good thing. Again, it's just identifying where they do and could sit on that pyramid. And I think that, there's one of the challenges we see is a lot of CEOs who will put in the annual report. They'll have a peripheral, a little impact hub, a little impact section or division within the business, but it's not genuinely implemented into the DNA of the business. So I'd urge anyone who's consulting to a company or working in a large company who wants to shift them genuinely into the impact investing section. It doesn't just work from the CEO. It has to actually go all the way down into the DNA of the business. And that means almost every employment contract, into the actual constitution of the business, into the actual facility documents when they raise capital, has to be talking about that. Otherwise, they could be creating great impact, but they'll still be in that sector of targeting primarily financial returns. So the final sector is obviously that one in the middle, which is above the impact floor and above the financial floor. Now, it's really important, if you look at where that circle happens to be, impact investing there, that blue circle, it's not necessarily creating the most impact, and it's not necessarily creating the most financial return. But critically important is creating a minimum of both, is creating above the floor of both. Now, the implications of that are pretty important. The implications of that are that they are able to collaborate and attract stakeholders or shareholders from every area of the spectrum, which can provide material advantage. So what it means is that Street, instead of targeting 2% of philanthropic capital that's around the world, can actually access that other 98% of capital that targets financial return. It means that a for-profit company that genuinely hits that impact floor, they can start to target government support or government resourcing or philanthropic support or resourcing or NGO collaboration in a way that a profit maximizing company may not be able to do. So there are really important strategic implications to this. This is an entire course run into half an hour, so I'm not going to go into any more detail other than to reiterate that I'm very happy to discuss in more detail anything you'd like to ask offline about specific businesses or ideas you've got. I'm more than happy to talk about that, or you could enroll if you want to see it in the CSI Social Impact Investment course. But in the meantime, I want to go back to you. And the reason I want to go back to you is I want to now, with that context that I provided, with that context about impact investing, what I want you to do now is go to this, and again, Rhonda Miller will talk you through it, but I want you to go through and I want you to talk about, now hopefully I can go here. What are the key drivers that would actually push you to make an impact investment? Now you can look at this in a couple of ways. You can look at this as an investor, or if you're actually more on the business side, you could look at it as an investee. But I want you to actually think about what it is that would drive you. Is it actually having the impact, or do you actually believe that this is the way to maximize returns, or are you just very interested in the fact that this is very innovative?
Michael, everyone's obviously inputting, which is fantastic. We've had a number of questions come through, probably about 10 or so. So I'm just really conscious of those time-wise.
Mm-hmm.
I can ask one of them now if you like.
Well, I was just going to talk through this and then actually turn over to Adam. So maybe we can hold the questions to the end when we're done with that.
No worries.
Not that I'm avoiding questions. I just thought that might be a better way. So interesting here to see that impacting investing is driven at the moment, certainly by the 100 people in this group, by the social impact side, as opposed to believing it's necessarily the way to maximize long-term returns. However, more than half of you, or over, you actually do seem to think that this is also a way to maximize long-term returns. So I think that's probably reflective of the broader industry. I think there's very few people who invest in impact investing only because they think it's the way to maximize returns. Primarily it's driven by an impact mandate. However, it does require this belief that over time, it is the way to maximize returns. So on that note, I want to turn over to my good friend, Adam McCurdie. He's going to talk a little bit about Humanitix in the context of impact investing. Turn over to one more Menti poll and then finish with some Q&A.
Thanks, Michael. And yeah, thanks for having me on. I'll share a bit of background about Humanitix and see where it crosses over with impact investing. We're quite a unique one. So I think it raises a lot of interesting ways of looking at the topic and different opportunities for innovation. So yeah, I'm one of the co-founders of Humanitix, based here in Australia, in Sydney. And well, why does Humanitix exist? So Humanitix exists to close the global education gap. And we do that domestically by funding a range of Indigenous scholarships for bright young Indigenous students that come from immensely disadvantaged backgrounds. And they are a fantastic bunch of programs. Internationally, we fund and we focus on literacy programs, life skills, numeracy, and literacy for girls in low-income countries. There's just a vast, overwhelming amount of evidence that suggests the awesome amount of social impact that can be gained through funding education for young girls, young disadvantaged girls in low-income countries. And so that's what we're about, and that's what we aim to achieve and what we aim to maximize, and the reason we exist as an organization. What makes us unique is how we go about doing that. So Humanitix said, well, we don't want to be dependent on creating our impact based on the generosity of philanthropists or donors. So instead, we're going to work out a way to sustainably fund these education programs and do it in a way that could potentially achieve astronomical growth and therefore astronomical impact. And so what we've done is we've gone and disrupted the online events ticketing industry. So whenever you buy a ticket to an event, whether it's a conference or a workshop or a festival or a gala dinner or anything like that, you'll go through a ticketing platform, and that ticketing platform will charge you a booking fee. It's typically about 5 to 10%. And those booking fees simply add up to billions of dollars across the planet, and they present an awesome opportunity to be redirected into funding the likes of Indigenous scholarships and literacy programs for young girls. So that's what we did. We set up Humanitix, which essentially runs its own events ticketing platform that event organizers would use typically instead of another platform like Eventbrite, and there are many others. And our view was to create a completely no-brainer switch for any event organizer that's running an event and needs a ticketing platform to use Humanitix over any of the regular platforms out there that don't have an impact mission. And so for us, it was really important that we were lower priced. So we're priced well below, our booking fees are significantly below the likes of Eventbrite, etc. Our impact is incredibly transparent. So we report on every single event that gets ticketed through Humanitix. We report live in real time to the organizer exactly the level of Indigenous scholarships or girls literacy programs that their event has funded. And then thirdly, we strive to be simply the best technical solution for the market. So half of our team are engineers, and we're striving to say, we don't expect the market to make any sacrifices. In fact, we're actually aiming to be the best online events ticketing player so that it's a completely no-brainer solution. And we've worked really hard there, and that's what's led to our growth, particularly over the last couple of years. Where it's unique for Humanitix is that we intentionally set ourselves up as a not-for-profit. So Humanitix is actually a registered charity. And we did that to essentially have no shareholders. So there is no equity value in Humanitix. Myself, my other co-founder, we don't own any equity in the business because there is none to own, being a not-for-profit. And so when it came to funding the vehicle of Humanitix to allow it to grow and establish itself, it created quite an interesting conversation, which was, typically we might have been able to go out to a venture capitalist or an impact investor who would say to us, love the business, love the upside, love the opportunity, love the impact that you guys stand to make. I'd like to, give you money in return for some equity. But in a not-for-profit structure, we can't do that. So actually that restricts us to purely debt only if we were to embark on an impact investment. Humanitix to date hasn't taken on any debt to raise its money, and it hasn't given away any equity to raise money because it simply can't. But it certainly was interesting. Our view was that we want to go with whatever structure maximizes our impact and simultaneously gives the organization the best opportunity for success. Our view is that given that our impact comes purely from our profits, by having a group of shareholders who want to extract a return from the model, we would always be diluting the impact we make in order to pay the shareholders a return. We could never, you'd have to play some balancing game. So our view from day one has always been that if we can pull this off as a not-for-profit, that potentially would yield the greatest amount of impact, because we would be able to not having to be using our profits partially to pay investors, rather using all of our profits to fund Indigenous scholarships and girls literacy and life skill programs. And so for us, it's been an incredibly interesting journey. We're now in Australia, New Zealand, and we just this year launched in the US. And we're growing quickly. But the impact investment space is evolving. We've done some unique things with the likes of the Atlassian Foundation and the Google Foundation, who both funded us. But yeah, these are the kinds of decisions that, Humanitix have had to make, and the kind of conversations that we've had to grapple with, which is this idea of wanting to have a model and a business that maximizes impact and can fulfill on your organization's mission. But at the same time, giving yourself the opportunity to get access to the capital that's going to allow you to flourish in the best way. So it's been a fascinating journey. We're still continuing to learn. And so despite us not being probably the most stereotypical impact investment type of organization because we're not a for-profit business that a VC could invest in. It still raises some pretty interesting concerns to what Michael was talking about there with a company that has a mission and a vision around its impact, its why, which for us is education of disadvantaged kids, and how it goes about achieving that, and the access to capital that it exposes itself to. So yeah, I don't want to go on for too long because I know there's a lot of questions, and it might be more interesting and colorful if we go back and forth on some questions.
Absolutely. So Adam, thanks for that. And just before we jump to the Menti question, just a bit of context, further context. There's an organization that you may want to research, Compartamos Bank. They set out with a complete social mission as well. And their mission was to provide access to capital for women living in rural Mexico to begin their business. And they were very successful. They were so successful that they were profitable, even despite being an NGO. And that provided them the opportunity to do an IPO, raise a substantial amount of money in order to scale the business. And they had a similar concept, a question to grapple with is, Adam, are we going to best deliver on our mandate by raising that capital and delivering our product or service to 200 times as many people, or are we going to be selling out and essentially bringing in a group of stakeholders who are pulling us away from our mandate? Now, what happened to them was the latter, and they actually jumped right over impact investment sector and into being one of the most profitable banks in Mexico or in Latin America, but no longer really delivering on their impact. So it's a very challenging question. Do you bring in the capital that allows you to scale as a successful social enterprise, or do you avoid that trouble, but then have other challenges? And I saw a couple of questions coming through. How do you then attract that capital? So on that note, we'll jump to our last Menti survey before we go into Q&A. And that is, should Humanitix raise impact investment capital and all of the challenges that come with it, but obviously with the scale that comes with it too, or should they remain as totally as a not-for-profit? And by the way, Adam is not bound to the final answer on this.
Looks like a good level debate.
Yeah, which I think reflects the reality of impact investment for a successful social enterprise. Is, of course, it provides wonderful opportunities, and of course it provides huge risks as well. And without having more information, probably it is difficult to be sure. Given, Adam, I know in the past you've always had to grapple with these questions despite having huge amount of information. Okay, so that's great. I think that shows really the right approach to that. So on that note, I am going to stop sharing this screen, and we'll move to Q&A, which Rhonda will manage for us.
Hi, everyone. Okay, heaps of questions coming through. Actually, a quick one for you, Michael. Can you repeat Compartamos Bank? Is that how you say it?
So this is, whenever I have students who come from Spanish-speaking backgrounds, they always have no idea what I'm saying until I write it down, and then they say, "Oh, Compartamos Bank." So I acknowledge my pronunciation is very poor. It's Compartamos, Compartamos Banco. So Rhonda, I can send you a link to it after.
Do you want to put it in the chat box for everyone?
I will.
Thank you. I'll ask the first question. I'll actually go to Adam first because there's a number of questions. As soon as you started speaking, a lot of questions came through. So from Maxine, in response to your presentation, how did you generate investments?
Investments as in how did we attract capital to fund Humanitix?
I assume so. Maxine, if you want to unmute and just confirm. Okay, Maxine might not be there. That's
yeah.
Oh, there she is. Go
yeah.
Maxine.
Yeah, you just explained what you couldn't do, but I wasn't clear on what you actually have done.
Sure. So all the capital that we have used to fund Humanitix was initially out of myself and Josh's pocket. We've been the biggest donors and contributors. We self-funded it and bootstrapped Humanitix for its first 2 years. And that was purely done by donating our money and time into the business with no potential for a return via equity or anything like that. Then when we started to hit our stripes and the model was proving to be exciting and organizers were starting to switch more and more into the Humanitix platform, we raised money in two ways. Both were philanthropically. So one was straight from private high net worth philanthropists who were excited at the idea of donating to a not-for-profit that just needed, if it works, a one-off donation to then get itself to be sustainable and generating a significant multiple on the money that it took to create Humanitix in the first place. And for similar reasons, we got grant funding from two foundations, the biggest being the Google Foundation, google.org, and the Atlassian Foundation.
Yeah, you mentioned those.
Yeah, and they funded us philanthropically with no ownership or financial return opportunity.
So that was to start up basically your idea.
A combination of, in the early days, the high net worths were to that startup and the bootstrap capital. By the time the Googles and the Atlassians came around, that was really kind of more of the growth scale-up type capital.
Yeah. Okay.
So, we might move on now because we've got heaps of questions. Sorry, Maxine. So did the funding from Atlassian and Google constrain which causes you could support? That's a question from Paul.
Yeah, good question. So with the Google money, they simply loved what we're doing, and Google back a whole bunch of different causes, and they just thought we were a fantastic impact with technology type of idea that they would like to get behind. With Atlassian, it didn't restrict us, but it was more just, it aligned with our mandate. So the Atlassian Foundation have a mission of educating 10 million disadvantaged students over the next decade. Their foundation is all about education. And that fits perfectly with our mission and ambition, our impact mission at Humanitix. And so it was a very awesome alignment. Now, what the Atlassian Foundation did that was quite unique, which suited us very well too, is they said, well, we scout the planet for the best education programs that can work to educate our goal of educating 10 million disadvantaged students. We think some of the best of which are these girls' literacy and life skills programs that we fund. If we give you money, will you ensure that these girls' literacy and life skills programs that we have vetted along with the Gates Foundations, etc., have found to be some of the most impactful, will you promise a large portion of your funding will go there? To which we said, this is a marriage made in heaven, because we don't have the resources to go out and scout the planet to find the best education programs for us to redirect the booking fees to. So if we can piggyback off of your research and your IP along with the Gates Foundation, et cetera, they pour all their resources into identifying the best stuff to fund. And then we do that as part of a deal that says, yes, you give us money and we try and create a multiple on that money into these programs that you're funding anyway, and you vetted. Well, then that's a perfect partnership and then collaboration. And so that's where with the Atlassian Foundation, we really recognize that we were arguably being restricted, but we were being restricted in the way that it's perfect. I mean, we can't do personally a better job than the Atlassian Foundation right now to find better impact projects than they do because of the resources they pour into it. So, yeah.
Thanks, Adam. Another question here, and Michael, I might get you to answer this one. So it's around measuring impact. So Lana had a question about that. Can you share some examples of companies who have really great reporting on their impact? But also in addition to that, Kate asked, are investors genuinely interested in evidence of impact, or is a good news story enough?
So I'll answer that question in a couple of parts, and I just want to, in doing so, also quickly address Amanda's question, which was very relevant to CSI. First of all, I just want to reiterate that I'm not an expert on impact measurement. So there are people within CSI who are, and who we can connect you to if you have specific questions. But your question about is there essentially a greening of the message? Are there companies that are putting out a wonderful story about impact but not genuinely doing it? And the answer is yes, of course there are. Just like there are companies who have falsified or exaggerated financial expectations of reporting. And what we're currently developing and need to develop are better ways to see through that. And that's where a lot of the students doing their studies at CSI will go into their organizations and be able to see through that and implement more holistic, more truthful measurement techniques. But also it goes beyond measurement, and it goes into the actual ability to start incentivizing your employees to deliver on these social impacts. So it's not just about measuring it, it's about creating incentives. We all know that's what drives humans, a lot of human behavior. And that's why when I talked about implementing it into the DNA of the business, it's about moving it away from just superficial reporting metrics and into people's actual bonuses, for example, or job descriptions reflecting that impact. So I think that's one of the ways of really addressing that. I also just want to jump onto the question from Amanda Young briefly. And the reason is that what you've identified there is absolutely correct. There's a lot of capital. I mentioned before, there's a lot of capital seeking investee businesses, not that many businesses that can accept it. And one of the reasons is because we're not putting enough money into early stage businesses. And the reason is that any early stage business is risky. When you add in the additional complexity of having two mandates of social and financial, it becomes very challenging. And that capital needs to be coming along with enough resources, both financial and expertise, to help a not-for-profit develop the financial capability, or a for-profit develop the reporting and measurement capabilities. And that can be very challenging. So just looking back at what Adam said, first of all, a really important aspect is collaboration. Don't try to become an expert at everything, but bring in expertise in the areas that you're lacking that skill set. And the other thing is to start shifting the dial of where capital is willing to invest, what type of risk capital is willing to take. And we can't go into too much detail right now, but that is something that we're working on, very exciting in CSI. And if that does interest you, that particular area, that early stage impact investment area, please do get in touch, because we're looking at various ways we can catalyze the industry.
Great. And just on impact measurement, we have had one webinar, the recording will be available soon, with Paul from our UWA location. And then there's another one coming up on the 2nd of June with Awana from CSI UNSW. Hasn't been announced yet, but just keep an eye out for that if you're interested. A question from Cynthia, either of you could take this. What do you think should be the intersect between social enterprise and impact investing?
Adam, do you want to talk about it in the context of Humanitix, and then I can speak about it generally?
Yeah, so Rhonda, do you mind just repeating that? It just broke up right in the crux of the question.
Yes, what do you think should be the intersect between social enterprise and impact investing?
Geez, I really think that's difficult to answer. I mean, in impact investment, I think Katz touched on it quite nicely before, which was that for impact investing, you really have to be making a strong case for a strong financial return. And you're a compelling proposition for a serious institutional or private investor or syndicate who is seeking to maximize their wealth, but now they have this new form of vehicle to do that, which is significantly better for the planet and its people. But a social enterprise is something that doesn't necessarily fit in there, but it does attempt to at least cover most, if not all, of its costs in a more sustainable model compared with the typical charity structure. So a typical charity is every single year completely dependent on donors funding the charity, which is also arguably a great model, depending on what you're trying to do. Because if you're a charity, you can just focus on your impact work and get your funding from your philanthropist or whoever's donating to you. But there is no revenue stream outside of donations that partially covers your costs or wholly covers your costs. And I think a social enterprise is simply attempting to do that, which is to say, how can we make this model a lot more sustainable so that we're not as dependent on philanthropists compared to a charity, which again is different to a more impact investment organization or suitable organization, which is saying, I can really give you a strong return if you're a serious investor. And then that's probably more characterized as an impact investment.
I think that's a great description. And what essentially we're saying is it's a continuum, and it's not binary. You're not one or the other. It's a continuum. Look at that spectrum. There are organizations that sit on every single dot along that spectrum. Some are total charities, some are totally for profit, some are a little bit above a charity, creating a little bit of revenue, some are almost an impact investment. Each of those is operating in a space that, or could be operating in a space that reflects its potential opportunities and that reflects its actual underlying ambition and strategy, as Adam keeps on repeating. What was Humanitix's actual purpose and what was the reason of creating it? And that's driving their decision making. So the intersection is that some of those operating as a social enterprise could go to impact investment, and that's wonderful, but not all of them have that opportunity. And it's critical to understand the potential and the objectives, and to understand it's a continuum. And for Street to be doing what they're doing, to be raising, let's say, 75% of their required funding through revenue is a wonderful thing, but it doesn't make them a financial investment. And it's really important to understand why each place sits where they sit, and to understand that it's a spectrum, and there are a million little spots along that spectrum that you could sit.
I'd love to just kind of add to that a little bit and link to something you said earlier around that intentionality of an organization, that, you know, impact can't just be a side byproduct of what's being done there. There's real power in setting an intentional impact why. That just so happens to as well be a strong financial proposition for an investor. And we've seen that personally at Humanitix, where we've set this very intentional why all around our impact in education. And what that's led us to is being much more open into addressing other challenges and problems. The biggest of which we saw was, once we started getting going in the ticketing world, we actually attended a hackathon at PwC, and it was for solutions for people with disabilities. And we started to talk to a range of people with varying accessibility requirements and disabilities. And they said, oh, don't get me started. You're a ticketing provider? Going to events is an absolute nightmare. I've completely given up. I don't go anymore. Our ears pricked up. We said, why? Tell us. And so we got into long conversations with all these different people and found that as the ticketing provider, we actually hold the key to many of the accessibility problems being experienced at events. And from the feedback we were getting from them, no ticketing platforms interested whatsoever in solving these, and they pull their hair out. So we said, wow, you know what? Let's go do our best to solve this. And we've now dedicated a fortune of resources to building an accessibility tool, which is the first of its kind, to working with Vision Australia to vastly improve the accessibility of all the sites and its assets on the site. Because we just ingrained it in our DNA of, you know, that's what we're about. And this is something fascinating and interesting that we've discovered on our journey, and recognize that, hey, if we're not going to do this, then no other platform is seemingly going to do it. But it all stemmed from that intention of the whole why of the project in the first place, that just made it such a logical thing to just tackle or do our best to try and improve as part of what we were doing already.
One last question and we'll finish off, I think. And I just want to say that we're using Humanitix for Impact 2020. And it's been a very smooth process. I would highly recommend it. So we'll finish. I really like this question. Maybe for Michael to answer. What can the wider community do to improve awareness and involvement in impact investment?
That's a great question. And I think it actually stems to the broader question of anything to do with innovation and entrepreneurship. I think there's a misconception that in order to operate in some of these areas, you need to be 100% in that area. So if I want to be involved in innovation, I need to be an entrepreneur running my own business. Or if I want to be involved in impact investment, I need to be running an impact investment business or working for an impact investment fund. Totally untrue. The broad change will come from, as I mentioned earlier, looking at the graph, those of you who are just generally interested in this, those of you who start to incorporate it into your consumption decisions, those of you who incorporate it into your employment decisions, those of you who ask the questions of your employer, what are we doing to create more of an impact? Where could we sit on this curve? Those of you who think about ways to, just on a small scale, on your team, on your small team, how can we implement incentives in our employment contracts that reflect this broader social considerations? So I would say that there are those who will be completely dedicated to this, through to those who will make very minimal decisions about this. And that will change throughout your individual lives too. Sometimes you'll be totally able to dedicate. Other times life gets in the way and you can only do it peripherally. What I would say is have a look at your own life. Think about how you're using your time, how you're using your money, how you're using your knowledge, and think about how you can incorporate it, whether how big or how small, into considering these concepts of creating these outcomes where there are genuine financial sustainability and genuine social impact into the DNA of the organization or the decision making. And if you can start to do that, we'll start changing organizations from the inside out, and that's when this thing becomes a lot bigger than just a 5% allocation.
Wonderful. A great way to end. Everyone can take their own steps to have that impact. I'd like to thank Michael and Adam as well for participating today and for presenting. I really enjoyed it. I'm sure others have too. We didn't get to every question. I say that every webinar, but Michael has kindly shared his email address, and I'll do that again in the follow-up email that I send in the morning. But thank you very much once again to everyone who came along, and check out impact2020.online for other webinars. And we'll see you soon. Thanks, Michael and Adam.
Thanks, Rhonda, and everyone.
Bye.
Thanks, Adam.
See ya.
Thank you.